Imagine this. You're investing millions in a shopping center. But when the market turns, who gets paid first and who gets wiped out? That's not a gamble you want to guess on. It's decided by one thing, the capital stack. And if you don't understand it, you're walking into real estate blindfolded. Today I'm breaking down the capital stack, the critical structure that determines risk, reward, and who gets paid first in commercial real estate investing. If you're looking to make smarter investment decisions, this is something you need to master. The capital stack is the layered structure of how a commercial real estate project is financed. Think of it like a skyscraper, where each floor shows who gets paid first, who bears the most risk, and who enjoys the highest potential returns. The capital stack is divided into 4 layers. At the very bottom, you have the foundation, senior debt, which is the most stable concrete base of the building. Moving up, you find the mezzanine debt, like the sturdy steel beams connecting the foundation to the upper levels. At the top of the skyscraper, you've got preferred equity and common equity, the penthouse investors. Each layer comes with its own level of risk and return, which we'll explore in detail. We'll start at the bottom with the lowest risk and make our way up to the highest. At the bottom, you have senior debt. This is your bank loan or other type of insurance or CMBS loan. It's the most secure position with the lowest risk and typically requires a 5 to 7.5% return. If things go south, the bank gets paid first, even if it means foreclosing on the property. For example, a $10 million shopping center might have $6 million in senior debt. The bank expects consistent payments, no excuses. Above that is mezzanine debt, the steel beams that hold the structure together. It fills the gap when senior debt isn't enough. This option has moderate risk and moderate returns, with investment returns usually ranging from 8 to 15%. If the project fails, mezzanine debt holders are only repaid after settling senior debt. Preferred equity investors contribute funds in exchange for a fixed return or preferential payment. They have rights before common equity holders. This type of capital has a higher risk and return than mezzanine debt, with a general return of 10 to 15%. An investor might contribute $1 million as preferred equity to a shopping center project, earning a guaranteed 12% annual return. Even if the property underperforms, preferred equity holders get paid before common equity investors see profits. Finally, at the top, you've got common equity. This is where the sponsors and investors willing to take the most risk to where they live. They get paid last, after all debts and preferred equity obligations are satisfied. However, they typically share in the project's profits, which is why they potentially have the biggest returns, with returns often ranging from 15% to 30% or more. Here's the real trick: balancing debt and equity. More debt means potentially higher returns for equity investors, but also greater risk. It's called leverage, and it can make or break a deal. Understanding the capital stack isn't optional. It's your roadmap to knowing who gets paid first, how much risk you're taking, whether the deal aligns with your strategy. Don't just hand over your money and hope. Ask about the stack. Know your position. If you found this breakdown helpful, give it a like so more people can learn how these deals really work. Subscribe to stay ahead in shopping center investing. For guides, case studies, and investment opportunities tailored for you, go to rockstep.com and check out our Learning Center. The link is in the description. Once again, thank you for watching and see you soon.